Good afternoon, colleagues. I think we're going to start. The governor's been telling us that when it's 4, it's 4. You know, we have to do the new president's timeline. Thank you very much for making it. I mean, it's a good crowd. The last time the governor was here, I think it was about 2 years ago, it was actually not just, a full house, but it was very lively, even outside of the session itself, the formal session, because the governor has committed to be with us when his diary permit, almost every year, because he enjoys engaging with students. So we are happy to see him again. And we've got the VC as well, who will introduce the governor soon. So to start off with the protocols, welcome VC. Thanks for making it, Governor, and welcome to the DVC, Prof. Leach as well, and Prof. Pepeta, and Dr. Randall, the officials from the university, and also to the students, because I think the main point of the discussion is for students. So we're also happy for you to be here. So I'm going to ask the VC to come and open. And then after that, the governor will speak, but the governor prefers to take his own questions. So he will speak and then take the questions. And then we'll ask the Dean of Business Economics to come and close the session afterwards, and then we can have social after that. Thank you very much.
Okay. All right. I hear now I'll sit in front afterwards. They're telling me now, because I would not have come if I was told up front. Thank you, ladies and gentlemen. Again, I want to greet both Vice Chancellors that are here this afternoon, and the Dean of the Faculty of Business and Economic Sciences, Acting Professor Hendrik Lloyd, and I've seen the Dean of Health Sciences, Professor Pepeta. I'm sure there are other deans that I've not seen who are sitting here. Oh, there is a Dean of Engineering, the Built Environment and IT, Dr. Franks. And I would like to welcome all the deans that are here, and the Dean of Students and members of senior management, the director of the business school, Dr. Jonas, and the governing body, advisory board of the business school, the university management, the professoriate, students, and members of the metro, the community here in our city, and then members of the different spheres of government that are here this afternoon, and the educators, members of the business community, including the Business Women's Association, the Nelson Mandela Bay Business Chamber, and NAFCOC, and members of the civil society structures that are here represented. I think I've recognized our students ngokupheleleyo. I want to greet our governor, ladies and gentlemen. It is a privilege to warmly welcome Mr. Liseja Kganyago, the governor of the South African Reserve Bank, to Nelson Mandela University and his team. This is his second public lecture, as it has been said by the DVC, Mr. Hashatse. It is his second lecture, and we are delighted that the governor has indicated, as it has been pointed out, his commitment to sustain this space of public dialogue and debate by giving this public lecture annually, if his diary is permitting. We are delighted by this commitment, Governor, and I commit the resources of the university to support the annual lecture program and to expand it to a bigger space, because there's been a lot of interest on this. Intellectual dialogues of this nature, I believe, create important platforms for discursive engagements, and they are very much in line with our own commitment as the university to create hubs of convergence where the university meets community to converse and explore solutions to practical problems that affect our immediate communities and broader society indeed, so that together we chart new and alternative trajectories. Governor, my reading of this commitment stems from your abiding stance or mindset to serve a cause greater than yourself, a cause whose genesis and evolution goes back to the years you spent as a public servant, primarily as the Director General of National Treasury. These were the years when you were actively involved in directing the resourcing of strategic national projects in an endeavor to set our country on a course to become a winning nation. Indeed, this public duty platform was the formalization of your long years of political and civic activism to contribute to efforts of liberating our country from the yoke of apartheid. I served as a DG at the same time as Governor Kganyago in the province, so I've been very privileged to be touched by his common values as well as intellect in one human being. Your own contribution in having left behind a resilient national treasury remains one of the lasting impressions we have had in the South African public service. As it invariably happened in the 1970s and 1980s, where the educational aspirations of activists were disrupted, Mr. Kganyago was to drop out of his studies at Wits and then had to later find his way to qualify for his undergraduate degree from UNISA. As the country was preparing itself for democracy, he availed himself, along with many others at the time, for overseas postgraduate studies. In this case, he went to the University of London at SOAS, where we studied together as well. So I'm really very proud that you are here. What he went through in his formative activist days instilled in him principles and values which centered and grounded him and prepared him well to be of service to the people and his country. This has subsequently earned Governor Kganyago many accolades as one of the best administrators, managers, and public leaders, rising to the leadership of National Treasury, as I've said, and thereafter being appointed as one of the youngest governors of the Reserve Bank in the world. As you all know, Governor Kganyago earlier this year was appointed as the chairperson of the International Monetary and Financial Committee, which is the policy advisory committee of the Board of Governors of the International Monetary Fund for the term of 3 years, effective from January this year in 2018. We are very proud of this as your compatriots, Lesetja. 2018 also became a year when our governor was voted by his peers as the Central Banking Governor of the Year. Christopher Jeffrey, chairperson of the Central Banking Awards Committee and editor-in-chief of Central Banking, in announcing this award said, and I quote, "The South African Reserve Bank's Lesetja Kganyago faced a tough year. He had to defend the central bank against serious attacks from public institutions, maintain investor confidence when the nation's debt was downgraded, and weather a government reshuffle that threatened financial stability, while anchoring inflation expectations and building the South African Reserve Bank's capacity to handle its part of South Africa's new Twin Peaks supervisory regime. Governor Lesetja Kganyago has enhanced the South African Reserve Bank's reputation and has striven to anchor inflation expectations, improve operations, and build capacity, all the while standing firm against unwarranted political interference in his efforts to serve the people of South Africa." Close quote. I thank you for your thought leadership, both here at home and increasingly in the global sphere, monetary sphere. Your contribution has been sterling indeed. I wish to thank and salute the Faculty of Business and Economic Sciences for hosting this important lecture here at the Business School. We look forward to your address, Governor. And I'm not going to say the title. The Governor will say it himself when it comes, the title of his lecture. I know, though, it will stimulate debate, and I'm looking forward to a robust engagement around the ideas that you will be sharing with us. Enkosi kakhulu, manze nethole.
Thank you very much, VC and the management of the university and all professorships observed. And good afternoon, ladies and gentlemen. Over the past year, I've been talking about the topic or the area of central banking, the mandate and the role of the bank. And importantly, I had to talk about the history of the South African Reserve Bank. And I had to talk about the history of the South African Reserve Bank because we are the oldest central bank on the African continent. And in 3 years, we would be celebrating our 100th anniversary. And so when we first talked about this lecture, they said that I must talk about the history, the role of the central bank, and democracy. And I had a sense of some jealousy because I've talked about this topic at the other universities. But this time round, coming here, I figured out that, well, this is Nelson Mandela's centenary. Let's make it special. So I will come with a different topic from what people wanted me to talk about. Because in a young democracy like ours, we face challenges. And one of the biggest challenges that we face in South Africa is the challenge of inequality. And so my topic today is inequality and monetary policy in South Africa. Debates about inequality have kicked into a higher gear in recent years in academia, in policy circles, and in the broader political space. For central banks especially, those in advanced economies, inequality has become an inescapable issue. And experimental policies like quantitative easing have been blamed for making it worse. In South Africa, we have had very high inequality for a very long time. So for us, these debates are not new. Nonetheless, there are new ways of thinking and new data to help us understand the issue better. Today, I would like to make a couple of points to clear up some misconceptions that people may have about inequality, and more specifically, about the interactions between inequality and monetary policy. First, although everyone knows that inequality within countries has been rising, inequality between countries has actually been coming down. This is thanks to sustained growth in emerging markets, which are not as far behind the rich country as they used to be. Second, in South Africa, inequality has been persistently high, but the composition of inequality has changed. Inequality among black South Africans has increased since the end of apartheid, so that South Africa's inequality story is now about class as much as it is about race. Third, people often don't know where their family fits in South Africa's income distribution, chiefly because people who are relatively better off often do not realize how much poorer most other South Africans are. And that helps explain my fourth point, which is that the relationship between inequality and monetary policy does not quite work the way people usually think. Lower interest rates typically worsen inequality. I'm going to spend a large part of my talk today explaining the four most important channels through which monetary policy affects inequality, namely inflation, borrowing costs, asset prices, and employment coupled with growth, to show how this all works. But let me start with the global environment. Over the past few decades, global inequality has either risen sharply or begun to moderate, depending on how you look at it. Inequality has risen in the sense that inequality within countries is often higher than it used to be. As Thomas Piketty and others have shown us, for example, inequality in the United States has been rising since the 1970s and is now at levels last seen nearly 100 years ago in the 1920s. Similar trends are visible in many other countries. This increase in equality has captured many headlines and has also been cited as an explanation for political developments like Brexit or the outcome of the last US presidential election. This rise in inequality is usually attributed to changes in technology, productivity, and the skills of workers, where the return on higher and newer skills has accelerated faster than returns to less skilled workers. However, inequality has also fallen since the 1970s if we look at gaps between countries. 50 years ago, the gap between rich countries and poor countries was very clear. Nowadays, there are a lot more middle-income countries. There are also many more rich and middle-class people in countries that used to be almost universally poor. To take one example, 50 years ago, even rich people in China were typically worse off than the poor people in the United States. That is no longer true. The rich in China are now rich from a global perspective, thanks in part to several decades of strong economic growth. The same thing is now happening in India, which is also catching up with richer countries because its economy is growing at around 8% a year, while advanced economies are growing at around 2%. This decline in worldwide inequality is a big change, reversing a trend of steadily higher inequality between countries that has held since the Industrial Revolution. The reduction in inequality is driven by some big trends: better economic policy making, growth in world trade, the spread of technology and finance, and more education. However, the fact that people in poorer countries have been catching up with those in richer countries does not mean that the world has become equal. In fact, the world as a whole is probably more unequal than almost any one country on its own. For instance, while there are now more middle-class Indians than ever before, the country has also become more unequal internally. Estimates suggest that the Gini coefficient of the whole world is around 0.7. To put that in perspective, a relatively equal country like Sweden has a Gini coefficient a bit below 0.3. The coefficient for the US was around 0.35 in 1950 and is a little over 0.4 today. Brazil is at 0.6. South Africa is around 0.7, which makes it one of the most unequal countries in the world, and certainly the most unequal large country. South Africans know that theirs is an extremely unequal country. However, there are some aspects of this inequality which are not well understood. One is that inequality is no longer as completely determined by race as it used to be. Historically, of course, inequality in South Africa was fundamentally a racial story, with access to economic as well as political rights and opportunities based on skin color. Since the end of apartheid, however, this has begun to change. Inequality within the African portion of our society has risen, as more black people have moved into the middle and upper classes, while others have stayed very poor. As a result, inequality among black people is higher than for the other racial categories in South Africa. The Gini coefficient amongst Africans is above 0.6, about the same as Botswana and Lesotho and Swaziland, countries which are less racially diverse than we are, but still very unequal. Another aspect of inequality that people tend to get wrong is the contribution of monetary policy. I'm often struck by the comment that higher inflation reduces inequality by benefiting poorer South Africans. The core of this argument is that higher inflation creates more jobs that go to poorer people. Another part of the argument is that because more households are highly indebted, and because poorer households are the most indebted, interest rate cuts will disproportionately improve the welfare of those poor people. I would like to assess those arguments as well as a couple of other monetary policy channels that are less discussed, in an effort to get at a deeper understanding of how monetary policy affects inequality. I will discuss the four main channels through which monetary policy affects inequality: borrowing costs, asset prices, employment and growth, and finally inflation. I will demonstrate that a decision to go for a loose monetary policy is likely to worsen inequality and make it more extreme. What South African households borrow for and at what rate of interest depends mostly on their jobs and their income. We can break these households down very roughly into two groups. The top 20% of the income distribution and the bottom 80%. A team at the University of Cape Town has built an online income comparison tool which tells you where your household actually fits in, and which I suggest everyone should try. To give away the punchline, however, if your family income exceeds 173,000 rands a year, or about 14,400 a month, then you are in the top 20% of households in the country. Getting into the top 10% of the income distribution requires just under 270,000 rands a year, or 22,500 a month. The average government salary is 335,000 rands a year, which is within the top 10%. Compare those income levels to a household in the poorest 10% of South Africans, which is getting less than 17,721 rands per year. That is under 1,500 rands a month. That is roughly a tenth of what a family just within the top 20% is getting. These income differences play out in the amount of debt households can take out and the interest rates they pay. When the Monetary Policy Committee of the South African Reserve Bank moves the repurchase rate, households immediately see the difference in their mortgage payments or their car payments. But what does this do for inequality? The reflex answer is that as South Africa, there are both rich and poor people, and the poor borrow from the rich. So higher interest rates increase inequality, whilst lower interest rates or looser monetary policy reduces it. But this is misleading. South Africans in every income bracket tend to have a lot of debt. The National Credit Regulator reports that there were a bit more than 25 million credit active people in South Africa at the end of last year, which compares with around 16% people who have some sort of employment. Don't we just love credit? We've got 16 million people who have some sort of employment, but there are 25 million credit active South Africans. However, South Africans borrow for different things through different parts of the financial system. Most mortgages for homes and most loans for motor vehicles are taken out by that 20% of households earning the most income that we talked about earlier. Lower down the ladder, the composition of debt changes. Mortgages and vehicle loans more or less disappear. In their place, we see more high-cost debt like store cards and informal loans, Abu Mashonisa. These kinds of debts carry much higher interest rates. Crucially, these higher rate debts are also much less closely tied to monetary policy. When we move the repo rate, which is the rate at which commercial banks borrow from the central bank to fund their reserve requirements, the decision has a direct and strong effect on the prime rate, which is the rate at which commercial banks lend to their safest customers. This, in turn, changes the loans that are tied to prime, such as mortgage loans and vehicle loans. To put numbers on this, we currently have the repo rate at 6.5%. The prime rate is 10%. The average interest rate on a mortgage is also 10%. But the average rate on a motor vehicle loan is almost 12%. As you can see, if you reduce the repo rate by 25 or 50 basis points, people with mortgages and vehicles get a nice savings. They actually celebrate. But the same repo rate move has little or no effect on a microloan, which has an interest rate of roughly 30% or an informal loan at an even higher rate. As a result, there is almost no relationship between the repo rate and the interest rate on higher cost debt. Put these two facts together and we get an interesting application. Changes in monetary policy have a much stronger impact on the top 20% of households than they do on the rest of the population. That is not because poorer households don't borrow. Rather, it is because they borrow at interest rates that are shaped by factors other than monetary policy, including higher costs of offering loans, higher risks of default, and lack of communication about income. Actually, many poor people, when they borrow from a microloan, they do not even check what the interest rate is. They just get told, you can get a 50,000 rands loan and all that you have to repay is 1,000 rands a month, and they are happy. What is hidden in there is the interest rate that is associated with that loan. So when interest rates go down, therefore, the more highly indebted and wealthier households save much more on interest costs than the poorer households do borrowing at micro loan rates. This by itself worsens inequality. Now consider asset prices, a channel which is often poorly understood. As with borrowing costs, people tend to think that higher interest rates reward rich people who have savings. Again, this intuition is misleading. In fact, much of the global debate about inequality and central banking rests on the exact opposite claim, that very low interest rates exacerbate inequality. This is because lower interest rates raise asset prices, and an increase in asset prices benefits those people who already have assets. We have seen this play out in advanced economies following the global financial crisis. As central banks cut rates as low as possible, house prices, equity prices, bond prices all soared. The winners were the people who had already invested in those assets. Those who lost out were younger people who could not afford expensive homes, as well as savers who had their money in interest-bearing accounts. As you can see, what really matters for the asset price inequality channel is the distribution of wealth. Who has assets? In many advanced economies, the middle classes tend to have substantial stocks of housing wealth, even if most stocks and bonds are owned by richer people. This means that higher asset prices don't necessarily raise inequality because enough people have assets to start with. In South Africa, the situation is different. Most assets are owned by people at the top of the income ladder. As one researcher has commented, 10% of the population owns more than 90% of all wealth, whilst 80% have no wealth to speak of. A propertied middle class does not quite exist. For this reason, a low interest rate policy that pushes up asset prices will only magnify inequality. This may also explain why some asset managers are opposed to interest rate increases and publish angry articles in newspapers when we decide to raise rates. In fairness, asset managers aside, most people argue for lower interest rates. And most people who do not really take these effects into consideration. Instead, they are focused on employment. As they rightly observe, reducing South Africa's extraordinarily high unemployment rate is crucial to fighting poverty and moderating inequality. The problem for us at the central bank, however, is that interest rates are not the right tool for addressing South Africa's unemployment problem, and especially not the joblessness among the poorest households. In undergraduate economics classes, you are usually taught simple models in which there is a short-term trade-off between inflation and employment, the so-called Phillips curve. One explanation of the Phillips curve relationship is that lower interest rates create more demand, which in turn creates more jobs, but also creates more inflation, hence the trade-off. Another explanation is that higher inflation destroys the value of people's wages, so they become cheaper to hire and employment rises. Well, the empirical evidence for the Phillips curve, however, is just not there, as researchers have repeatedly reminded us. In fact, South Africa tends to get stronger economic growth and more job creation when inflation is low, in part because of demand effects, but mostly from stronger productivity growth and investment. It is the wisdom of the inflation targeting framework that we focus on something within our control, something which is important for balanced and sustainable growth over the long term. Targeting employment and not inflation could worsen inequality even more, especially if we were specifically trying to target employment for the poorest South Africans. This is because poorer households are more disconnected from labor markets. In fact, as data from Statistics South Africa tell us, jobs are not even the primary source of income for the poorest 30% of households in South Africa. Instead, these households rely heavily on grants. For the poorest 10%, which is around 1.3 million households, 60.9% of income is from grants. and just 13.9% is from work. People tend to use the term working class to mean poor people. But the poorest third of the South Africans mostly are not working. Joblessness is fundamentally a structural problem, explained by factors such as quality of education, skills shortages, and settlement patterns. People are not living nearer jobs. These are not problems that monetary policy can solve. If we did have the ability to create jobs generally, that would be a powerful tool for reducing inequality. But in fact, as a central bank, our ability to create jobs for anyone is weak in the short run and non-existent in the long run. If we were in a skills-rich country like the US, with flexible labor markets, there would be a respectable argument that low interest rates could help ease inequality by bringing down unemployment caused by a recession. But that is not the economy we got. That's not the labor market we got. So this isn't an option for monetary policy here. The final channel I'd like to discuss is inflation. Inflation is a problem from an inequality perspective because it tends to hurt poor people more. One reason for this is that poorer people have less choice over spending. Poor people's consumption baskets are mostly taken up with a few basic items, especially staple foodstuffs and shelter. Richer people buy more kinds of things, so they have more room to adjust away from items that get too expensive. A second reason why inflation exacerbates inequality is that it is harder for poorer people to protect their wages and savings against inflation. If you have a job where you get a cost of living increase every year, or if you have some assets which keep their real value despite inflation, like Kruger rents or a house, then you can avoid much of the pain of inflation. But if you are not in a position to negotiate with your boss, or if your savings are in cash, inflation can hurt you badly. Given these factors, a monetary policy stance that lowers inflation can actually increase the expenditure of the poorest South Africans, even as it reduces the buying power of the richer South Africans. The conventional wisdom about a short-term growth-inflation trade-off, therefore, needs to be supplemented with the knowledge that this also poses a growth inequality trade-off. Or, to put the point more simply, any decision to tolerate a bit more inflation for the sake of a little extra growth is also a decision to make inequality a little bit worse. Unfortunately, South African inflation has tended to be high, and it has been even higher for the poorest South Africans. Our inflation target is a range of 3 to 6 for headline inflation. Since 2010, inflation has been above 6% for 28 months, just over a quarter of the time. Meanwhile, the inflation rate for the poorest 10% of households has been above 6% for 51 months, which is about half the time. With an inflation rate of close to 6% on average, South Africa has become a relatively high inflation country. Almost 3/4 of the world's countries have lower inflation rates than we do. This suggests that we haven't taken the battle against inflation far enough. We hope to remedy this by anchoring inflation nearer 4.5%, the midpoint of our target range, as we have repeatedly said in our MPC statements. The poorest South Africans should be amongst the biggest beneficiaries of a low inflation policy. To conclude, monetary policy affects inequality through several channels. Low interest rates tend to push up asset prices, helping those who have assets already. Low interest rates also reduce borrowing costs. but mainly for borrowers at the high end of the income spectrum. Interest rates have weak and limited effects on employment, especially for the third of the households which are not closely connected to labor markets or which are disadvantaged by having less education. Where monetary policy tolerates higher inflation, this tends to reduce spending power, especially for the poor. Put together, all this suggests that a more inflationary monetary policy is likely to make inequality worse. As the guardians of the value of the currency in South Africa, it is important that we at the South African Reserve Bank bear all this in mind when we make monetary policy decisions. The richest 20% of South Africans can make themselves heard quite easily. They let us know when our raising of rates pushes up their bond repayments. They do a good job of getting a cost of living adjustment every year. They often don't realize how many poorer people there are out there because they assume they are roughly in the middle of the income distribution, not close to the top. But we, as the central bank, have to think about everyone in South Africa, including the other 80% of the households. I hope that today I have left you with a clearer sense of what monetary policy does and what it cannot do. At the simplest level, we know that low inflation has many benefits. So that's what we aim to deliver. But there are also many other policies and agencies that affect South Africa's worst problems, including poverty, unemployment, and inequality. Our contribution as a central bank is just one part of the fight against this evil. Thank you very much for your attention. So, we are coming to the most interesting part of the afternoon, which is your questions and my answers. So everything was so clear, there are no questions. And I don't know how you do it here, but where I come from, we say, can you please identify yourself and what you are currently studying? And then I will deal with your question. Yes, please. I can't hear you.
I thought maybe let me expropriate the opportunity without compensation. My name is Sandy Lempam. I'm a student here at Mandela. I'm doing my postgraduate diploma in economics. So I want to ask, you've been putting out a lot of fires since December. I won't talk about VPS, but let's enter the discussion of the nationalization of the Reserve Bank. Last night, a surprise announcement was made that rendered all public participation of the land question redundant, where the ANC announced that they would be amending the Constitution. Now, in the next few months, we've also been informed that the process of public consultation for the nationalization of the Reserve Bank will commence. Now, many are arguing from the unions within the ANC to say that the nationalization of the Reserve Bank is something that is long overdue because we are one of the few banks who are not nationalized internationally. Do you think with the rising pressure within the ranks of the government party that should the bank be nationalized, your mandate will be disrupted because it's the left thinkers within the ranks that are pushing for the nationalization. And now with the new administration and elections coming up, you will be under a lot of pressure in terms of your mandate. So do you think that the nationalization of the Reserve Bank is something that would change necessarily the mandate of the Reserve Bank, or would you maintain your autonomy as an institution?
The views are coming from the left. I am from the left, and I can tell you those views are from the right. I have been putting fires not since December. I've been putting fires since June last year, where somebody decided that they would want to change the mandate of the Reserve Bank. we had to fight that battle. And you must know that when you take a fight with us, we don't take any fight that we do not believe we can win. So we decided to fight that one, and we won it. The South African Reserve Bank is a creature of the Constitution. It belongs to all of you. It does have private shareholders. The anomaly is that those private shareholders do not own the bank. So when I hear people saying that the fact that the Reserve Bank is not wholly owned by a government is an anomaly, no. The anomaly is that you have got shareholders who have got no say in the running of the bank. That is an anomaly. So if you think you want to correct that anomaly, what are you going to say? Give them more say? I don't think that's where we want to go. But how did an institution like the Reserve Bank end up with private shareholders in the first place and find itself in the Constitution? How did it happen? You might not know that in 1918, South Africa experienced a banking crisis. So this thing of VBS and all of these things, no. South Africa experienced a banking crisis in 1918. What was the source of the crisis? The source of the crisis was that every bank in South Africa issued its own currency. So, if you went to Standard Bank, you got Standard Bank notes. If you went to Nedbank, you got Nedbank notes. You go to Capitec, you get Capitec notes. And of course, these notes were supposed to be backed by something. And the banks kept gold in their vaults, so they were supposed to be backed by gold. What led to the crisis was that there were many of these notes, and it turned out that there wasn't sufficient gold to back up these notes. And some of the banks were, because I don't want to say how old are you, but the older folks in the room will know that the bank notes in South Africa used to have a line that says, I promise to pay bearer on demand the amount of 10 rands or 20 rands in Pretoria. It was because it was backed by gold. So you could, during those days, take your money back and say, can I have my gold? But as it turns out, when some people wanted to have their gold, there wasn't enough gold in the bank. So we had this banking crisis. And so a decision was taken to say that, can we have a common standard here? And the banks held out and they said, no, what do you mean? Of course, those banks that had the gold and believed that their notes are worth more than the notes of others were opposed to these new rules. So a decision was taken that in 1920 that we are going to create a South African Reserve Bank. You remember when we created the South African Reserve Bank in 1920, the Swedish people had had their central bank for more than 200 years. And so, a decision was that we are going to create the central bank. But the government didn't have money to create a bank. Right? It's like one of these debates that are currently taking place. The government didn't have money to create the bank. So where was government going to create money? The government then said to the banks, okay, we are creating this bank, and we want you to take shareholding in this bank because we do not have the money to put in. And so over a period from 1921, although we had a central bank, the central bank was not well capitalized. And it had to take, the decision was taken to say, we must go and get South Africans to put money in a central bank, buy the shares in a central bank. And in so doing, there was a concern that, wait, but it is the banks that caused a crisis in 1918. We must constrain them. And how are we going to constrain them? No one will be allowed to own more than 10,000 shares in the central bank. It took a number of years before the shares were fully subscribed and the Reserve Bank had the capital. That is the history. That is the history. And so, when we adopted the Constitution, or before we drafted the Constitution, there was a set of constitutional principles against which the Constitution must comply with. I will not bore you with all of them. You can only read one. One such principle said, there must be a central bank with a sufficient level of independence to protect the value of the South African currency. So when the Constitution was written, it had to comply with that. And actually, the first draft didn't have the clause that covered this. And the lawyers pointed out that if that clause is not there, the Constitution will fail the must when it is tested. It was tested in court. So such a clause was subsequently incorporated in the interim Constitution until the Constitution was finalized. Interestingly, nothing in the Constitution or in the constitutional principles talked about the ownership of this institution that must protect the value of the currency. So, the mandate of the bank is in the Constitution. You can nationalize the bank. Well, I don't know what nationalizing means in this case. Let me say you can buy out the existing shareholders, because I can tell you, you cannot expropriate them without compensation. I can tell you that. So you will have to buy them out. You will have to buy them out. And so the question then that came is, if you buy them out, how much do you pay them? So some of the share price of the Reserve Bank is trading at just over 2 rands or so. There is one shareholder who believes that his share price in the Reserve Bank is worth 10,000 rands a share. Multiply that by the 10,000, that means that he is talking about 100 million rands of the shares. That now you take those then into space, then the numbers get very big. And so this thing of the Reserve Bank, you can have as many public hearings if you like about it. At the end of it, does it pass the constitutional must? And is that rephrasing of the clause in the Constitution, will it be consistent with those constitutional principles? If it is not, it will not pass. But I hear, at least I read from the resolution of the ruling party that said that you must nationalize the Reserve Bank without making any shareholder rich, right? Which is an interesting one, because if you buy them out, you're going to have to make them rich, and without changing the mandate of the Reserve Bank. And I said, thank you. At least somebody understands the Constitution. So you can take out the private shareholders and pay them. That is fine. If you don't change the mandate, you probably can carry the thing through the Constitution. It's not a problem. It's been done before. The Bank of England got nationalized. The Bank of Spain got nationalized. Bank of Belgium got partly nationalized. There are about 7 central banks that are still privately owned. So it's no big deal, the thing about ownership. The question is, would you protect the independence of the Reserve Bank and leave it to execute its mandate in terms of the Constitution? And if you do that, you could leave it like that. The Turkish the Turkish Central Bank was also created almost along the same lines. Turkish citizens were called upon to put money to create the Central Bank of Turkey. So these things have happened elsewhere in the world. Central Bank of Turkey has not been nationalized. It still has this shareholding by the thing. But whatever figure the government pays the shareholders, since we are economists, right? Your professors told you about trade-offs in economics and choice and public choice. Whatever amount we pay, call it 100 million, call it R1 billion to pay for the Reserve Bank. Why would we pay R1 billion so that we own the Reserve Bank instead of putting that money to build new clinics or fund education? Why would we do that? But the problem of public policy debate in this country is that it's just too emotive. It's driven by people who, when you argue with them, they tell you, please don't confuse me with your facts. So there was another question here.
Charges, the banking costs, and so on. What leg of government really has got a big say in the charges? So that can sort of curb the
Is the National Credit Regulator. They have been very active in that space. And the problem that the National Credit Regulator has is that these people also pop up everywhere. And then what happens is that you put in the regulations to protect the poor, and you know what the poor do. They leave that regulated sector and they find another informal fellow. And and those fellows, they say they get paid. They get paid better than the banking sector, but their collection methods are pretty questionable. They are some of these people who take you down a dark alley, break your kneecaps, and get you to pay them.
Use a monetary policy to better the lives of South Africans and protect them against petrol increases. Like if we use monetary policy to strengthen the rand so that you can buy the oil cheaper temporarily, and then maybe later on when the oil prices are down, you could lower them. Is that possible? Is that feasible?
That's very interesting. You have just called for higher interest rates. Look. The petrol price, okay, let me start from this. As South Africans, we must accept that there are certain prices we do not have control of. The oil price gets fixed by a cartel called OPEC. We're not in there. And the exchange rate depends on what happens globally and what happens domestically, and sometimes the clever or stupid things we say could affect the exchange rate. So the cushion, and this is going to be striking. You're gonna love this. You're gonna love this. The cars are concentrated in that 20%. And so when you say that we must do something about the fuel price, you are talking about the 20%. That's what you are talking about. The 80% use public transport. And so if you want to support the 80% subsidized public transport, then we are okay. And so if you look at the cost of public transport over the past 3 years, it had risen at roughly half the price of inflation. I'm not talking about the tax, I'm talking about subsidized public transport. It's been contained. So that is what we are talking about. Unfortunately, in the 20%, I wish I could get onto the household survey. But if you want to know in that 20% how many are black and how many are white, go into Statistics South Africa, the household survey. I can't pull it now because I must take the next question over there. I am a regulator. So if something is unregulated, don't tempt me. I might just say I want to regulate it. You said you are doing an honors in economics. I like it because this morning I was engaging with high school students and they talked about cryptocurrencies, and I noticed you didn't use that term. You said Bitcoin and blockchain. And that is because those things do not qualify as currencies. Because currency must meet the following 3 criteria. It must be a generally accepted medium of exchange. It must be a store of value. You can say that thing passes the test because it has some value. That is why people are trading it. And third, it must be a unit of account. And that is not a unit account. We do not measure GDP or the financial statements of any company using Bitcoin. We do not do that. Okay? So now you talked about blockchain. So before I get back to the blockchain, so what I did to create a little unit, and for us to figure out how these things work, I had to say to the chaps, here's some money, can you trade this thing and explain to us how this thing works? And they study these things. I employ a lot of clever people. So they study these things for me. Blockchain is a technology. And that technology, although it was really popularized by crypto assets, it is useful beyond crypto assets. Let me give you the South African story. Recently, we piloted a project called Project Coca. Project Coca was the utilization of blockchain technology in the national payment system to settle wholesale transactions. The technology was able to settle for us the transactions that we processed throughout the whole day. We were able to settle them in 2 hours. So that was the potential of the technology. So the technology can be used for other things other than the cryptos. Are we concerned about crypto assets? Yes, we are. What concerns us about crypto assets? You see, my nephew, who is in Muleji, in Limpopo, I want to tell you now that you give that chap a bag of oranges or a box of tomatoes to sell them, he will not be able to sell them. He might end up eating the oranges. But he tells me that he is trading Bitcoin. And I said, can you explain this thing to me? He says, no, Malumi, I can't quite explain it. But do you know what? People are making a lot of money from it. Now, one of our first big concerns has to do with investor protection. That there are lots of people who are involved in this thing and are trading this thing who have got no cooking clue of what this thing is. The second is that because of that anonymity that you had, what we had seen is that the bad guys who peddle drugs, want to finance terrorism and have stolen money and so forth, because if they come through the banking system, we catch them and we close their bank accounts, they have run to the crypto space. And that is a concern for us, and it has got implications for law enforcement in countries. It is something that is the focus now of central bankers. Every 2 months we meet as central bankers of the world. One of the things that central bankers are constantly talking about is what this thing actually means for us. There was a hand. Yes, sir.
Yes. My name is Peron Molwan, postgrad financial planning student. I've got about 2 or 3 or 4 questions.
Yo.
But you can summarize and put them into one, and the other 2 also. So that's actually 2 questions. The unemployment grant was tabled before Parliament, I think 5 years ago, by the EFF members. They said they gave us the info from the US that in US it is currently running that unemployment grant in US people get 10,000 rands. unemployment grant. On top, they get RDP houses. They suggested that South Africa adopt the same strategy, but not that of the 10,000 rands, but 3,000 rands. What is the stance of the Reserve Bank as in accordance to that? That was tabled 5 years ago. The second point is the food vouchers for also the unemployed in the locations. 5 years ago also, they used to get 1,200 rands per month as per voucher. That has now been phased off. Last year, I'm sitting at the house where we are 4, all of us is not working. We got now 756 in August last year, once a year. Only now again we are going to get another one. And that voucher program was a monthly program. Why did it deteriorate like that we only get it now once a year? So if you can also, if you are aware of that, we can try and answer. Then the last 2 questions. I'm a postgrad student doing internships. I've been in and out of the companies trying to do my internships, knocking on each and every door, but I've been declined by so many companies. Your Mercedes-Benz, your Old Mutual, your William Hunt, General Motors, and many others. And also, there's no place for me within our institution also, the Nelson Mandela Institution, but we're coming from here. On the last one, the NFSAS. The budget speech in February by Malusi Gaba, Minister of Finance, gave the higher learning 57 billion for our higher institutions, and there's about 56 institutions national. Within our institution, we saw a internal communique within our students, where thus far, as in August, we have received about 94 million. So, and we are almost over half the year, almost 8 months towards the end of the year, with 4 months to go. So, when are we getting the balance? The 800 million. Because we are
Okay. Very good questions. Wrong guy. You see, I'm saying wrong guy because all those questions have to do with the budget. And if you were to ask the Minister of Finance his views about the monetary policy, he's going to tell you wrong guy. He will send you to me. So I would, if the university wants to invite the Treasury here, I can put a nice recommendation that they come. Yeah, but can I throw this one? Then you can go and ponder because you said it's unemployment grant. So it looks like we pay people so that they remain unemployed. How about paying them to be employed? And what was tabled, which had to do with youth, which was the youth employment subsidy, was something that we could be asking questions, because this would have taken people into employment. But intellectually, I always struggle because these things are about trade-offs. You know, you could give somebody pride by getting them to do something, no matter how little that thing is, and they feel that they have earned their money, than pay them to stay at home. I don't think that programs such as paying people to stay at home and they are able and would have preferred to work are viable programs. They actually destroy the dignity of people. By the way, the US does not have RDP houses. But I'm saying to you that we must be giving people dignity. And lastly is that There's notion that within our thinking that says, so because government has said that we would like to create jobs, but the jobs are not being created. Now we say, okay, let us pay for people to stay at home. I think we must, governments are not very good creating jobs. They're not. Jobs are created by businesses. So if you want jobs, you have got to create businesses or create an environment for businesses to thrive. Because, you see, business people, when they create a firm, they don't create a firm and say, I'm going to create jobs. But they know that their business without people is not going to get anywhere. So they end up employing people. And it is, if we change our national psyche to say that we should drive to create businesses, to create an environment for businesses to thrive, it is the creation of businesses that would lead to the creation of jobs. And when you have people with jobs, those people spend, and there is more economic activity, and you could take off. So the obsession that just comes and it says, how are we going to create jobs? I think the point of departure should be, no, but who creates the jobs? The jobs are created by businesses. So can we make sure that businesses are created? Then the jobs could be created. One of the last point I wanted to make is, as a country, we need to ask ourselves this question. Do we want to create a nation of job seekers? Or we would like to create a nation that creates opportunities. And those opportunities would be opportunities in business and opportunities in jobs. Could you imagine if coming out of university, the view would have been that the conversation that you have with me is not that I can't get an internship, is I have got this business plan. Believe me, I've got this business plan. I just do not have the money to get it executed. Then we are having a different conversation. So that is where I think that we should be shifting the national conversation to. The conversation we are currently having as a nation is a wrong one. Right at the back.
Now, as I look at South Africa as well, would you say that, I understand that the comparing the mortgage loans to store credit and the store credit and micro lending are slightly two different products. And looking at the crisis now in the United States, part of it wasn't anticipated, but there were people who made a lot of money betting off of mortgage securities. Now, would you say that if in South Africa, in the future, if the amount of debt were to increase, if the amount of store credit debt and microlending debt were to increase, would you say that we are heading towards either a financial crisis, or would you say that the accumulation of debt could affect our economy in the future? And what could our government do to alleviate that if such a crisis were to occur?
Okay. Firstly, I don't think South Africa is not heading there. If anything, the reason we were able to withstand the 2008 crisis is precisely because our regulation was stronger than in the US. I do not know if you heard of a term called NINJA. The term NINJA stands for no income, no job, interesting expenses. And what had been happening in the States was that a lot of loans were given to those ninjas. There were interesting loans where you had a mortgage and they tell you, you don't have to repay, you just have to pay the interest. You just had to pay the interest. But the psyche of the Americans was also a very interesting psyche. Americans were known to say, come out of their house with the kids and said, you can have the house, and they drive their car away. They would rather be in their car and not have a house. They will figure out renting or something. They seem to have since learned, because household debt in the US has come down. It has also come down here in South Africa. If you heard what I was talking about earlier, was the lower part of our society gets highly indebted, but then they get indebted with the wrong kind of debt, and that requires different protection. And there are all sorts of efforts by the National Credit Regulator to make sure that people play according to the rule. I am worried, and I'll tell you what worries me, is whether there are any ladies in this hall. Is that it? Well, ladies and gentlemen, thank you very much. It has been a wonderful afternoon interacting with you. I will see you again in 2 years.
Ladies and gentlemen, can we just settle down for the last minute or two? So it's my distinct pleasure to